All right, everybody, welcome back to the Cash Flow Chronicles. Today, I had an opportunity to listen to the earnings call on my drive home, and I would say my perspective compared to my initial gut reactions that I had looking at the numbers from Q2 earnings to when I listened to the call, I would say I flip-flopped 100%. And I think I I would want to say before I let kind of Chris enter the conversation, because I know he already had a great conversation with our friends at Finance Junkies, but the thing that I initially, I think, let get to me was the continued slowdown in growth and the continued kind of slowdown in net dollar retention and a lot of these key metrics that Palantir guided for in the right direction. I think the thing that hit me in the gut the most looking at it was the customer growth slowdown comparatively year over year than what we saw in Q1 of 2022 to 2023. And so with that, I still think 30 odd percent continued growth year over year for customer count is in the ballpark of where we need to be. And I think listening to the conference call itself gave me a little bit more of a jolt back to thinking about the long wavelength that Palantir is truly on comparatively to maybe the current numbers. And what do I mean by that? We haven't had the true opportunity as of yet to let AIP flow through the system. We had 1 month where you actually had it formally rolled out, and maybe 4 or 5 special companies that had the opportunity to look at this opportunity ahead of, say, everybody else in June. And listening to the conference call, it gave me a little bit of more understanding as to where we are in the next 12 to 18 months of the cycle. Now, for me, looking at this, and then I'll hand it back to Chris, I will say Palantir continues to be on watch in terms of revenue growth. It is somewhat scary. And the thing that I'm going to be looking out for particularly is at the end of the month when Snowflake reports, what's their revenue doing? Are they also seeing this continued slowdown in growth as well? And the reason why I'm not as surprised after listening to the earnings call is at this moment, just based off of how Palantir kind of grows their partnerships with everybody, AIP, as we know, is still very much in its infancy, has yet had the opportunity to truly expand and scale, has yet to truly even get ramped up at, several hundred organizations. It's really still in its trial phase, and they kind of iterated it very well. They kept talking to the last 10 weeks, the last 10 weeks, the last 10 weeks, and it's true. June 1st was really the start of a 10-week campaign. And the thing is I was really starting to think that day one, we'd get new customer growth. And day one, we'd start to see a little inkling of revenue. And in reality, we know how this company works. We know what's going to happen in the long term. And so I think I was letting my emotions and the hype of the stock being up 180% and everything started to I kept my calm, I would say, for probably the last month of everyone just getting so hyped up about what was going on. And I let it hit me all at the last moment when I was looking through the numbers and being like, okay, I know, like you probably heard me say last week, I'm not concerned about Q2 earnings. I wouldn't be surprised if they report in line, yada, yada, yada. And here I am, like initially listening to the Finance Junkie call with everybody talking, and I'm frustrated. And I didn't have the opportunity to listen to the call yet. I was at work. I was just looking at the numbers raw. And after listening to Sham, after listening to Carp, and after listening to the CFO talk through everything, it really puts back into perspective where we're at and how far ahead of the competition Palantir truly is and where we will go, not only now, but in the future, because, and I think this was something that was said very late in the Q&A session, American enterprises and global enterprises are just getting to the point where they're fully understanding what they need to do to implement themselves to be a modern enterprise. And before, they were just mostly using Excel and Microsoft Teams and thinking that that was the digital transformation that they needed. And in reality, they're just opening their eyes to what they need to do, which is ontologies, large language models, and having the appropriate artificial intelligence and back maps in their organizations to truly utilize that and leverage that going forward. So, Chris, I realize I just had a 5-minute monologue. Anything that
That's good.
like makes you initially feel, or do you just want to hop into how you felt listening and looking at the earnings call?
Well, to me, let me just unshare the screen real quick, and then I'll do my own quick diatribe. My holdup with Palantir is not that I'm bearish on the company. I think the company's mission is amazing. Like if you can't get behind the mission of this company, I'm sorry, you have no heart. Like literally, it's protecting democracy. So I'm not against the company for its mission, which some people are. Like if you look at the people arguing against Palantir's adoption in certain companies, the main reason is primarily driven by politics. And mine is completely opposite from that. My thing is the valuation. The valuation is stretched. And the thing is, when you have a stretched valuation, it's just very hard to justify paying such a high price. And it's okay. Some people can wait around for this price to basically go forward, right? Me, I'm an opportunistic, and that's just who I am as an investor. So I'm looking at things from an opportunistic standpoint and saying, look, I think the valuation right now is a little too high. And based on any metric that you're looking at for Palantir, it really is very high. But that doesn't mean that the numbers aren't reflecting a positive trajectory. Because I think that's one of the things that actually makes me bullish on the company, but not at these prices. And that's the unfortunate thing, because I know some people think that I'm like an ever bear, and I'm not an ever bear. I have a price that I think that it would be a fair value for Palantir. And I'm actually going to go over some of the quick numbers that I had in between Finance Junkies and doing this Disney thing that I could actually show you guys, and just show you where we've actually come from last year versus where we are today. And then we can go from there. So you can share that screen real quick. Matt, there you go. So this was filed with Palantir's earnings, and this is very, very clear consolidated statement of operations. You can see that the revenue right now on a per quarter basis is about 533 million, which last 6 months is about $1 billion. What's very interesting is in terms of cost controls, they've really adopted a stringent amount of cost controls. So you can see here from an operating expenses standpoint, they've only gone up by 4 million, but their revenues have gone up by 60 million, right? So they're trending in the right direction. This is what you kind of want to see for a business where they're actually making the positive steps in order to be more shareholder friendly, right? You want to have a company pivoting in a direction where they're not just diluting shareholders, where they're not just selling, hiring people that are providing no real value. And I think that's one of the key things with most companies right now on the Wall Street, that they all realize that the age of unprofitable growth is behind them, and that they need to now pivot to things that actually work. So Palantir really has taken a big step towards that. And I mean, these guys went from an income loss of about $276 million last year in the first 6 months to actually a positive $50 million in income, which is amazing. The problem is the valuation is still relatively high. It's $38 billion market cap company for a price that's like this. So do I think Palantir eventually gets to a value that it's $18 and $20 is fair? Absolutely. Maybe it could happen by 2025. Maybe it could happen at 2026 levels. But right now, I don't think is the time that this company deserves to be at a $18, $19, $20 valuation. This company should be trading more around $10. And the thing is, when things are good, it's easy to overlook valuations, and it could say, you know what, I don't mind overpaying. But let me tell you, when the bad times come and people are looking to trim companies from their portfolio, they're going to trim the ones that they feel are overvalued. And that's just not me. That's like generally how the market operates. But one of the really great things, like I said, with Palantir, they've really, really taken a good measure of reducing down their expenses. So if you look at right here, this is for the last 3 months. They went from $11 million in cost of revenue to 8. Their marketing and their sales, they spent 50 million last year. Now they only spent 38. So you can see overall they're trending in the right direction. What I liked is that they didn't cut too much in R&D. Whenever a company starts cutting so deep in R&D, that's like a bellwether that, there's there's not much in terms of innovation left in the company, and they're just doing a cash grab at that point. So I'm not a fan of when companies like start cutting back on R&D. But overall, from a operating standpoint, the business is trending in the right direction. When you look at a company from an equity standpoint, they're $400 million more equity in this company now than there was in the past, right? I mean, the share counts have gone up also. So once again, if the shares go up, the value of that equity is going to be lower on a per share basis. So that's one of those things that we have to be a little bit more concerned about. But overall, they're in a good place. The cash that they have on hand, they're utilizing it correctly, which is putting it into short-term investments in like treasuries. So you can see here their interest income actually jumped. So in 2022, when interest rates were really low, they were only generating about $2 million every 6 months, which is on an annualized basis of $4 million of income, to almost $51 million in the last 6 months of this year. So if you think about it from a capital standpoint, by the end of this year, they'll have generated almost $100 million in just money, interest income on the money that they are just putting on the side, right? And they're also at the same time generating more free cash flow. So their free cash flow is growing really, really well. So there's a lot of positives to this company and the direction that it's trending. So I think if you have a very, very long-term view of this company, it's not a bad company to be invested in. My only thing is just remember that you're paying a significant premium to what it should be worth according to a lot of metrics that most people would use. The other thing is their growth has slowed down significantly. But their operating expenses have gone down even more. So in terms of business operations, that's usually a good sign. Um, with regards to AIP, they're making all the right moves from a product standpoint, which is they're not pricing it so it's unaffordable where no one tries it. They understand that they're going to be one of the things that I hope that they don't, that I sometimes wish Carp would back off from, is saying that we're doing things that only we can do. No, that's not how any company works. The minute you think that you're the only guy that can do X, there's going to be 10 other guys that pop up that can start working on whatever you're doing, right? So I think right now with AIP that there's going to be other competitors out there that are providing similar things, maybe not as good as Palantir, but to say that we have no competition is in my opinion disingenuous. So I would say, Carp, just cut that out. Just be like, look, we have a best in class product that we're doing everything we can to market it out there and get as many people on it so that when people realize the value, they become long-term customers. Not just we're the best and no one can beat us. Like, okay, congratulations.
Yeah, yeah. No, I
Yeah.
agree with that. I part of me always wonders, right? Because I'm biased because of my recency, right? And having the
Mhm.
ability to use the product and know what's kind of coming down the pipeline, and having had used it for the past 6 years, using Foundry, I'm like, okay, I feel like this is the only thing that's on the market. But in reality, I've never tried Snowflake, and I've recently just
Mhm.
used Databricks, and so to have that full, I guess, real trial of what's really out there on the market in terms of what we can use from a operating system perspective and focus around data is pretty interesting. But I want to continue on with what
Mhm.
you were kind of talking about, which is the adjusted income that you're kind of looking at. So this is the thing that I've
Mhm.
always been looking at, is adjusted income and that adjusted cash flow from operations, which kind of takes out the share-based compensation piece. Because that
Mhm.
share-based compensation piece, as much as everyone likes to talk about it, and I understand, it's a dilutive effort. So, you always want to make sure that you buy shares and you maintain integrity of those shares, and that's kind of your sanctuary, right? But if you kind of remove that, I know it's a hard thing to stomach, and you look at what the true cash flow from operations from this organization is, it's back to kind of what you were talking about, Chris, in the 180 to $200 million range. I think it dropped to like 90 million this quarter, which I want to
Mhm.
investigate a little bit more. But this year alone, they're looking to get to about 500 or so. I know this is adjusted income, but I'd
Yeah.
anticipate the cash flow from operations will probably be about 500 million, which means
Mhm.
that they're going to add 500 million to the bank, right? So
Yeah.
when they were talking about $1 billion buyback, it's like, well, technically it's kind of 2 years of cash flow kind of coming in through. But the reason why I bring up the cash flow from operations being about 500 million for the year is if you take the company now at a $40 billion market cap, excuse me, and then you say it is a 500 million cash flow from operations, you're paying a price to cash flow from operations of 80, which is pretty rich, right? I mean,
Yeah.
if you think about it, you're not growing cash flow from operations that extensively. And so in reality, when you think about it, it's kind of like, ugh, that's kind of rich. But if you were to continue to be able to grow at, let's just say in 2 years, be at a closer to a billion, or 3 years, even close to a billion, you get your price to cash flow from operations to about a 40, which isn't awful. But once again, like, are you able to continue at that pace of, being able to have that much extensive cash flow kind of coming through the pipeline? That's where I'm kind of concerned of, like, where are we in terms of the overvaluation right now? Like, I'm not going to be adding shares at this point, because I think,
Yeah.
you're paying for growth at this point that's priced into fiscal year 26, 27. And so once you kind of get to that point, and even still, like, when I say the market cap's going to go to 150, 200 by 2030, 2032, I still think that the company's going to be trading at a very rich valuation even then, unless we truly see this demand kind of coming through. And when I get back to the demand piece a little bit, the thing that Crossroads mentioned in your Finance Junkie, he was just like, oh, it's kind of an independent platform. And, that was confusing to me until I listened to the call. And the thing that really intrigued me and kind of reinvigorated my little love that I've had, this relationship of love that I've had for the company for 6 years, is that he was right. I mean, the independent nature of AIP, which I didn't think was real. I thought when you got AIP, you had to sign up for Foundry, you had to sign up for Gotham, you had to sign up for Apollo in order for AIP to truly work. And to hear that they're implementing these things into existing platforms like Novartic and all these other companies that have already been on the ontology and the LLM sort of game for several years, and they're kind of not new to it, and they've been developing their own. And they mentioned the government space specifically, being able to use AIP to kind of plug in to their work. I thought that was a piece that shows the potential for when they do decide to start monetizing this, if ever, a huge potential for long-term growth. And I still think the things that were beneficial to me, I was upset by the NDR, the net dollar retention. I was upset by the customer count a little bit. I was hoping that would stay in the 40s. The thing that was exciting for me still was a 15% year-over-year revenue growth from the existing top 20 customers. So that going up 15% excited me. And then the other thing that they mentioned in the conference call, which made me pretty excited, was they're talking about, from a government perspective, and I'm sure other company perspective, other clients that they're using the Fed Start, not necessarily just for new companies they're using it from established companies to try to jumpstart their regulatory processes and the governance processes, because they've recognized in the government how strenuous it is to kind of build these things from scratch. And they're like, well, shit, let's just use FedStart. So you have a bunch of like little hooks, and part of me, and I'll get back to you because I'm really curious about your thoughts. Part of me is still sitting on this like dichotomy of like, well, the Foundry, Apollo, and Gotham revenue growth is shit, and it's gone down to 12% year over year. And, we're continuing to slow down. NDR is going down. But then you have this additional growth engine that, could kickstart some of that and get you back towards where you think. But my thought process is it, and getting back to the true question, yes, it's a fundamental great software, and I think it's kind of best in class. But is it really going to get you back to that 30 to 35% revenue growth that you would need to make this a valuation that you're seeing at the moment of $20 or $18, being in the $35 to $40 billion range, a fiscal year 25 valuation, understanding that when you do get that 30, 35% growth in say 5-10 years, you actually can get yourself to the $100 billion or $150 billion market caps that you really want to get to. Now, I know I took another like 5-10 minute
No, you're fine. You're
monologue
fine.
there,
You're
but
fine.
I'm really curious what your thoughts are with that.
No, I totally agree. I think a lot of their future success is going to depend on how they conquer this new market with this AI, this generative AI market, and how they're able to navigate around all their competitors, right? One of the things that I like about this is that they're actually realizing that, look, we don't need the money up front. We're not going to put this cost barrier as a wall against adoption, because in the past that's always been a problem, right? If you wanted Foundry, it's going to cost you an arm and a leg, which means that a lot of companies won't adopt you. And so if companies won't adopt you, that means that your exposure to the world won't be there. Whereas very light products like Databricks and Snowflake and everything else, you could just have them on. There's tons of developer community behind it that can help you, like utilize all the stuff. So even if the product is not necessarily as great, you can integrate it very quickly into your stuff. When it comes to Palantir, it's always been a problem with AIP. They're taking a different approach where they're just like, you know what, fuck it, let's give it away to people. Let's let them actually use one of our products and then slowly upsell them on the idea once it goes from there. So it's a whole different way of marketing their product. And I think what it is if the product is really that good, the showcasing of it will eventually tie into the revenue growth in the future. And so any sort of revenue growth in the future is what I'm going to be looking at, right? Not just a dollar for dollar amount, but I actually want to see meaningful contributions to their top line, right? So I think right now the slowdown to 13% year over year revenue growth is really bad. They really need to get back up to, they need to really apply back to the 40, do you know the 40 the 40 rule for
They
software?
they said Rule 40 in the call,
Yeah.
and I wanted, if I'd love to hear it because I was going to
Yeah.
research it today.
Yeah, rule 40 is when you have 20% growth and 20% EBITDA margin. That's a mark of a healthy company. So if you're growing 40% year over year, but your EBITDA margin is zero, it's fine. You're okay. You're still in a good shape because you're such a grower.
Got it.
Sometimes what happens if you slow down to like 20%, as long as your EBITDA margin is 20%, you're still healthy because you're still growing. So a lot of times people use that as a tool to benchmark against investing. Palantir is not there because their EBITDA margin, I think, just their net margin is, I think, like 3%. Now their growth is only
Yep.
12. So in terms of like a 40, like that rule is not good.
Mhm.
You kind of want to see. I mean, on an adjusted basis, you
Yeah, I
could
was
say
going to
that
say the adjusted
they're
basis. Yeah.
okay, because on an adjusted basis, I think they're like 27 and 13% in growth. So that would fit right into the 40 mark. But once again, on an adjusted basis is very creative in my opinion. I'd rather just go with straight EBITDA. And based on the straight EBITDA number, they're not that great right now. So
Right.
maybe if they started to reaccelerate some of their growth, they could eventually get to a point where they're much more likely to be attractive to a lot of like Wall Street, and they'll be able to move up. But right now, in terms of valuation, they're just very high in valuation, especially considering that their growth has slowed down so much. But, and I think right now there's a lot of euphoria from like retail investors in this company who don't necessarily look at valuation as closely as they should.
Right.
And that's why you can see like a lot of companies just run up. So my thing is, you know, when times are good, it's easy to overpay. But when things eventually start to calm down, let's say the economy goes into recessionary mode, companies like this are the first ones to get trimmed on a portfolio, in which case now, there could be pretty a substantial trimming. And so that could end up leading the company back down to more favorable levels. So for me right now, if Palantir would drop to probably like, I'd say $10 at the medium level, I would be a buyer again, but I wouldn't buy like a whole lot. If it dropped down to
Mhm.
6 again, I'd be a crazy buyer, but it'll never get back to 6 again. And the reason for that is because they have $1 billion in buybacks authorizations ready. So that kind of, it's almost like this buoyed support that's just
Right.
sitting there. So you don't want to, like, if you're trying to short Palantir thinking that this is going to go to zero, good luck with that. Their cash flow is positive. Their expenses are controlled. They've got 3 billion in the bank. They're not going bankrupt by any means.
Nope.
But if you're telling me that that this company is going to get to $6 again, I highly, highly doubt that that's going to happen.
So the one thing that I appreciate that context, and I'd like to hear your points of view sometimes outside of the FJ conversations, because I think sometimes when you're more short-term focused when it comes to that, and I think over here when you chat with me, you're a little bit more long-term focused. And the thing I want to get your perspective on is you and I thinking about the long term again and thinking about the products and the long wavelength. I've recognized that Palantir did that pivot that you were kind of talking about earlier, trying to hold their expenses as they continue to grow at a steadier pace. And do you think that that was a prudent thing to do? Because carp, how do I say this? Instead of continuing, because you think about it, they were still on an adjusted basis, cash flow positive, right? So they would have still
Yeah.
added cash to the balance sheet, even if they didn't become net gap profitable or gap net profitable, right? They still had that opportunity to continue to add money to the balance sheet. And I think people were just like, it's not profitable, it's not profitable, it's not profitable. And it's like, well, if you remove the non-cash items, everything's perfectly fine within the organization. Do you
Mhm.
think that because of their financial engineering that they're now doing, trying to balance getting the share-based compensation down to 100 million a quarter, trying to basically not grow, like what I'm trying to get to is, do you think that their financial engineering and making sure that they keep their opex down is hurting them in the short to medium term to getting to their long-term goal? What I mean by that is because they're not just going balls to the wall and trying to grow at all costs, and they're focusing now on the bottom line, that in the short to medium term, it's actually giving opportunities to companies like Snowflake and Databricks and all these other places to kind of catch up. When in reality, to me, knowing how to read a cash flow statement, I'm okay if they just maintain kind of that zero EBITDA sort of margin until they get to the point where they get all that aerial exposure that they want and as much clientele as they want. Kind of like what Amazon is doing, right? With the warehouses and e-commerce, they don't care if they're negative margins because AWS is kind of supporting it. And eventually they'll get it to a point where they can go plus 5% margin on the e-commerce like we saw on the US side of their Amazon business. And next thing you know,
Mhm.
free cash flow explodes. Like that's what I was anticipating Palantir. If you asked me 12 months ago, that's what I was anticipating Palantir was doing. They're making enough to keep the balance sheet going up and to the right. Cash was still coming in. Share-based compensation was keeping employees happy. And that was kind of how I envisioned it until the point where they were like, yep, we got as far as we need to. Let's turn on the drip. But in reality, it's kind of, and what Carp explained it as is they want to make sure that our customers believe in us because we're profitable, that the people and our clients believe us because we're profitable. So do you think in reality it's that is the real reason why they flipped the switch and said, let's pull back a little bit? And do you think that's hurting them in the short term? Sorry, I keep going around in circles,
Hmm.
but
No, no, no. I mean, so I think this is something that you have to take a step back and realize that this is not just them. Everyone is realizing that just because you spend $1 doesn't mean that you're going to get that outcome that's going to be positive, right? You look at how much money Meta spent on personnel and OpEx and CapEx and all this other stuff, and the real value, what did it really get them? So I think what it is Palantir realizes that and saying, look, if we want to be a sustainable company going into the future, we're going to have to be a little bit better with how we control expenses, how we control everything. And that when we do hire, we hire people that know what they're doing, but we're not overpaying them. And I think that's the key, right? About a year and a half, 2 years ago, there was such a big competition for talented workers that people were getting outrageous salaries and outrageous share compensations. And now I think a lot of that is starting to calm down a little bit. A
good
lot of
point.
layoffs
Good
from
point.
Google, a lot of layoffs from Microsoft, a lot of layoffs from Meta. So right now, Palantir can hire the new people at a lower rate of compensation. You know, maybe you don't get as many RSUs. Maybe you take more of a cash payment. So I think right now Palantir is benefiting from that, where they're still, in my opinion, still growing. Because the last time I checked, Palantir isn't laying off that many people. I think they were laying off maybe like 50, 60 people that were not in the technical side of things. So I think they're making the smart move in that regard, where they're saying, look, maybe we don't need to grow at a super lofty pace just to keep up with our partners. Like, it's better in terms of like long sustainable growth than having short blips of huge revenues, and then you build out this whole infrastructure or you hire all these people, and then the next year you don't have as much growth and now you got to fire all these people. That's an unsustainable business model where you're just like waffling back and forth between hiring and firing, right? So I think Palantir is just taking more prudent steps and saying, look, more linear growth is going to be good. The problem is that's not how the market works. The market is always going to reward you. I mean, not reward you. The market's always going to go irrational to pessimistic to irrational again. And especially with Palantir being more on the meme stock side of things, where there is a huge retail following, things can get bid up rather quickly for Palantir, even with a high share count. So I think the overt optimism can end up just going crazy, and people would just buy stuff at unreasonable prices. So I think right now, if you're a good investor, you can understand what I'm talking about and just saying, look, you know what? Maybe Chris is right. Maybe Chris is wrong. I'm overpaying for this thing. So my thing with Palantir is not that they're not a fundamentally a good company that don't have the opportunity to grow. It's just that their growth story is taking a slowdown, and the company is making some prudent moves and saying, look, long-term sustainable growth at a decent pace is better than trying to grow super fast one year and then slowing down super fast another year. And overall, the business is headed in the right direction. The problem is the valuation is way, way beyond that trajectory. So I think right now like I said, I would be very cautious on Palantir. The economy, in my opinion, is starting to turn a little bit. And if we do get hit by a recession, the last thing I know companies are going to want to do is just buy more software. They're going to say, let's scale back on our already existing contracts. And that's where Palantir's growth is not going to be there. So I think they're making the prudent steps and saying, look, we're not going to overhire right now. We're not going to overspend on marketing. We're not going to overspend on sales and screw ourselves next year when the economy is bad and now we got to fire all these people, pay people out, and at the same time take all these expenses and now try to explain to shareholders why we made a mistake. Instead, let's take a prudent, more conservative growth trajectory. Let's utilize AIP to really like ramp up our sales again. And hopefully that ends up carrying them to a higher growth rate in 2024. In which case, if it does, and you start to see a ramp up in growth again, where the growth rate goes to like, I don't know, 20% even, that's when the company is going to be like a screaming buy, depending on what the price is at the time. But right now, I would say there's a lot of overvaluation thanks to the retail hype, and I'm not a buyer at this price. If anything, this could be actually a good company to short, but I would not short it because
Yeah.
retail can push things way beyond way beyond what's rational. So I'd say right now the best thing to do is just chill. Just chill. A lot of times I don't understand this about people. They all say like, "Oh, Chris, you're not patient because you sell too quickly." I'm like, "No, I'm patient because I'm sitting in cash, waiting for things to get to the price that I want them to be so that I can buy them." You're the impatient one buying a company at $20, hoping that it goes to $40 next year. I'd rather buy things at 10 than 20. So
I will
I'll wait.
say, I think I've just recognized that my game is rather be invested. I'm not as good of a swing taker as you are. I'll either be too early or too late. And so to me, my game is just if I see an opportunity, I do like Rocket Lab, for example, is a perfect one. When they report tomorrow, it's the same boat that I'm in with Palantir. Is like I knew I was too early, and I knew the valuation was rich. Even investing in the direct public offering, I think it was like 13 or 16 billion. I think when it DPO'd. And now with the share price or the share count inflation, I think it's obviously gotten to where it is today. So I think for me, I'm with you. I think that $10 is probably a good price for today, but knowing that one day we're going to get this number, or when they decide to finally start hitting the revenue button on AIP, and it's just going to jump up 15% in a day, that's kind of what I'm fearing. And I think another piece is for me, which I'm also kind of curious about. Crap, I had it on the tip of my tongue, but now I'm kind of losing it. But I think that in reality, it's kind of just like it makes me wonder. My question was going to be for you. Are you going to sell any puts? Wait for some sort of downgrades or anything like that, or
No.
wait for it to kind of come in? You're not going to sell puts. It's too far out of the money at this point.
Yeah, it's too far out of the money where it makes sense. So the value that I would get from locking away that capital would be too much. So when you do, let's say a cash secured put at like, let's say $10,
Yeah.
you barely are going to get any sort of premium whatsoever. But at the same time, you're going to lock away your cash as collateral the entire time, waiting for something to happen. And so for me,
But you're actually going to get a good return, or should you just put it in treasuries at that point, get 5%?
yeah, I would rather be liquid right now, to be honest with you, so that let's say there is some sort of black swan event, inflation comes up super high and the Fed says, screw it, we're going to raise the 50 basis points again because inflation is reaccelerating, right? Now, I want to make sure I have liquidity so that when things dump, I can buy things up. There've been so many times in and I maybe this has happened to you. I don't know if it has or not, but doesn't it suck when things are on sale and you don't have liquidity?
Yeah.
Like that
Meta.
is probably the worst. Yeah. Doesn't that suck? That feeling of like, God damn it. I know this is a good deal, but I have no cash to buy,
Mhm.
So I don't want to be caught in that position where the opportunity cost is poor. So even like some of the Patreon people that I talked to, I said, right now we're collecting dividends on SLG. Like you're getting good dividends on SLG and some of the other ones. I said, you know what? Rather than trying to take the money and invest it again into other things, right now is a good time to build a cash position because when an opportunity comes again, you want to be liquid so that you can hammer in and get things at a really good discount. Why do you think Buffett is sitting on 145 billion in cash right now? Because the guy knows when the opportunity comes, he's going to be the first one to jump at it and buy stuff on the cheap. So like right now, if you look at puts for Palantir, let's say you go to the January 2024 $10 puts. How much are those? That's like way out of the money. But that's where the price target ideally is for
37
me.
cents.
Right. So what am I going to do? Lock away all this extra cash for 37 cents per share? Like it makes no sense to sell the put for it.
Yeah, 3.7% for 6 months. All right. So annualized, that's 7.4 or whatever it is.
Yep.
At that point, you're just waiting. It's like, would you just be prudent to kind of keep your cash on hand in a treasury or something like that?
Dude, you're getting like 4.9% of Robinhood Gold right now to just sit in cash. Not to mention there are still some other companies, like in my opinion, that are very liquid that have an opportunity to go much further, even under a recessionary scenario. Like in my opinion, Google. I think Google is so undervalued right now. So even though I have a cash position, every day that I'm doing more DD on Google, I'm getting more and more interested, man. Like,
did you buy any when I know you were buying Meta, right? And that's why I didn't have cash for Meta, was I was buying Google and Amazon. So unfortunately I didn't have the quite the return that you did on Meta. So congrats for taking profits on that, by the way. Not all profits. I don't know how much you sold, but you took some. And I agree. I think it's a good opportunity here to take a little bit for Meta. But my question is were you a net buyer of Google and Amazon when they were at the same time, or was Meta your big one?
Yeah, I did. I had some options contracts on Google and Amazon as well. Just not as many as on Meta, because Meta was down 70%, dude, from its all-time highs. And literally their operating cash flows was all being negatively charged by the metaverse spending, which the minute that Zuck said, look, metaverse is going to take back seat, I was like, dude, this is a very, like, in terms of undervaluation, Meta was the most undervalued among the FANGs. That kind of like the script is kind of flipped a little bit in that Google is the most undervalued FANG right now. So I am right now taking some of my wins in my Meta and actually shifting them now to Google instead, because I see Google right now with their cloud offerings, with their AI optimized cloud, it's just growing like gangbusters. They're generating cash flow from there. Think about it from this perspective. If a recession comes, Matt, are you going to watch less YouTube? Are you going to search less on Google? No, right?
Yep.
So that's one of
not
the
what
things
Tanner says, though. I'm just kidding.
No, but it's just one of those things that, like, I see Google as and they still have room where Google can actually make some cuts. But look at them, man. Look at what they're doing right now. It's It's nuts. Google is a cash flow beast. They've also authorized $70 billion of share buybacks. They have very similar operating cash flow, like total dollar amount, similar to Microsoft, yet they're priced at a 60% discount to what Microsoft is worth. So I'm like, dude, if you're telling me which company you want to bet on, bro, Google. Google right now is on like and the other thing is Microsoft pissed off Google, dude. Microsoft just came out and said we want to make Google dance. You woke up the goddamn sleeping giant that is Google, man. That was not a smart move by Satya Nadella. Now Google's on the warpath to take Microsoft out. So we'll see what happens.
Yeah, I think the thing that I don't know if I'm on mute or not. No, I'm not. Okay, good. Yeah, the cloud revenue piece. I think
you're looking at Q1. You're looking at Q1 2023. Q2 2023
really?
is where. Yeah,
that's why I was so confused.
Yeah.
That's the wrong one too. Earnings. Here we go. Let's see if this is showing up. But yeah, the thing that I was most excited about for was the cloud revenue. Kind of came in pretty heavy. It grew like what 30% I forget what it was. The numbers are out of my head at this point, but it was really nice to see, and it's starting to like actually be at that point where you get a lot of income generated from that, because it was just profitable last quarter for the first time, and now it's already in like the several hundred million in terms of income. I'm trying to see if they have it like readily available in terms of where it was.
There it is. They're operating income. That's what it is. You see right there, 395. So they had almost a $900 million swing from negative 600 million to positive 400 million. That's freaking crazy, dude. Actually, no, that's $1 billion swing. Sorry, in operating income for their Google Cloud services.
Yeah, So if they continue to add $1 billion, $2 billion, it's like this is going to increase. Because basically what I'm looking at is you added 1.8 billion in revenue, and that basically 50%, 40% of that went directly to the income statement. It's like, well, shit, if they're able to continue to grow this at 20, 30%, this is going to easily grow, very quickly as well, because at least for the time being, you're getting the majority of your operating expenditures are kind of getting covered at this point. So this is going to explode. So you think about it, say this goes to $10 billion next year. This is going to be something in like the $2 billion quarter range.
Yeah, so $8 billion a quarter.
$8 billion a year in terms,
a year, $8 billion a year.
And like, I don't think people are fully recognizing that. It's just like, well, shit, multiply 8 billion times 20, right? That's $160 billion of market cap. That's immediately, and that's just 1 year's growth, right? Imagine this grows 20 to 25% in the next year. This is going to be $8 billion a quarter. And then it's like, well, then add another onto that. It's like, well, then you're going to be in the 12 to $16 billion a year. Granted, that might be looking at fiscal year 26 or 25, but this isn't going to slow down. And I don't think people are truly putting that into perspective. And I know you are, but I don't think everyone else is. And I'm excited.
And then
everywhere else.
And you think about it, the price in terms of share buybacks, 70 billion. That means in 2 years, that's $140 billion of buybacks that you're going to end up seeing. So now the pie, slice wise, has just gotten less. So now on an EPS basis, you're getting a much bigger part of that revenue for being a shareholder. So like I said, my price target on this is about 200 by the end of next year. Just based on where it should be trading historically, 200. And just the amount 200.
And how much is that? Just
2.4 trillion.
Expansion? How much
2.4 trillion.
2.4 trillion.
2.4 trillion market cap. And also their PE right now, just off the top of my head, 27. It's a 27 PE on this basis, current basis, and a 22 PE forward basis, which is actually relatively low for them considering where they've been historically.
Forward 12 months or fiscal year 24
or forward 12 months.
Okay. So this is where I love getting into it, Chris, because like you and I mean, you're probably a little bit ahead of me. You got a few more years on me in terms of market, but this is the shit that people need to think about. People are looking for these goddamn home runs to an extent, and they're risking everything. what I did with Google and what I did with Amazon and what I did with Palantir and a few of these other ones, granted, I have more conviction in Palantir and Rocket Lab than most, and that's anyway, that's my problem, not theirs. I started with the end in mind, and what I mean by that is I said I want to look for companies. At this point, a couple of years ago, I was getting close to the 7-figure mark, and I was like, what do I want companies to be in terms of 6-figure positions in the portfolio? I was like, I know the S&P 500 will be, and it's already a 6-figure position in the portfolio, but I'm like, what other companies do I need, and what sort of growth in the stock price do I need them to be in order to get to that point? And so I was sitting there, I was just like, um I was like, I want Palantir to be at least a 6-figure position. I want Rocket Lab to be a 6-figure position. I want Amazon, Google, Shell, and a few of these other companies. It's like, well, how many shares do I need to own today? And where do I think they will go in order to get me to those 6-figure positions? And I wasn't just sitting, on Google, 6-figure, that's anywhere between 100,000, 999,000, right? So I was sitting there realistically being like, I think Google, from where we are today, this is a year ago, is probably going to be 3 or 4x where we are. One, you're going to have inflation, right? So you have to incorporate that, so you're going to get a 33% uplift on any earnings associated with that. Then you get to multiply that by a good amount too, in terms of just multiple and stuff. But then also just the growth of how great these companies are growing. And so I was sitting there being like, okay, I want Palantir to be at least a $200,000 position. I want Google to be at least a $200,000 position. I want Amazon. And so I was like, I need to have this many shares to be in spitting distance of that. Because to me, it's like, if it's not going to be that large of a position in terms of where my net worth is, I might as well just invest in the S&P 500. And so I was just like, that's how I've started to get to my position sizing. Is I want, if I hold it in the portfolio, it's going to be a long-term hold. I want it to be a several $100,000 position in the coming, not tomorrow, right? But in the coming 5 to 10 years. And that has evolutionized itself. And I want people to listen, because 10 years ago, I was literally sitting there with $0 in my pocket. And now I am where I am today. And so $500 used to be a lot. I remember I had like 300 shares or 100 shares of Sirius XM. I talk about this all the time. And I was freaking out every time it went up $5 and down $5. And I talk about it at lunch. The sandwich I was eating at lunch was more expensive than the loss I had on paper that day. And I was spending the entire time talking about it. That's how much like position sizing at that point. Then it went to $500 positions was a big deal. Then $1,000 was a big deal. Then 5,000. Then 10,000. And now it's getting to the point where it's like, I will move $30,000, $40,000 in a day, and it's not that big of a deal, because at the end of the day, it's just numbers on the screen, and I've gotten used to it. And, that emotion has kind of been removed from it to an extent. And so I'm kind of curious, throwing it back to you, is that similar to what you do in terms of position sizing, or is it not as complex for you? You just kind of say, I like this, I have money, I'm going to invest right now into this sort of position.
It kind of depends on the case underlying the stock, right? So if the valuation is so attractive and the story behind the numbers makes sense, then yeah, I don't mind going heavier than what I'm normally allocating. Like my portfolio position right now in Google is about 10%, right? I try not to go beyond the 10% mark. I try to limit myself, but if the stock gets over, like goes really high in terms of valuation, it can definitely make a bigger portion of my portfolio. I can't deny that. Like Google, like at one point, Meta was about 10% of my portfolio. It ended up being 25% of my portfolio because I just had so much damn gains on the thing, which is a good problem to have, but there has to be points where you also like, okay, what's the next thing what's the next story that people are not recognizing, right? Where is the value actually going to be? And I think that's where I differ from a lot of investors, where I know that there are times where I need to trim out of a position and find another one that not a lot of people have really looked into. And one of the things that I've learned, believe it or not, thanks to Vitaly, is, don't sell the entire position. Keep portion of it and let it ride. You know. So I think right now I'm gonna eventually, like my meta side, I'm still keeping some of my meta. I'm not never gonna let it go. I'm like, what, I wrote it up, let it go. You know. But in terms of position sizing, I think what it is more based on the undervaluation of of the company, and also the story on what's going on. With Google, the story to me is very clear in that, number one, they have a growing cloud business that's centered around AI, which I'm seeing everywhere doing my due diligence. Everyone is adopting and they're just absolutely killing it. You know, they have their own hardware division with their TPUs and stuff. So they're not nearly as bottlenecked as some of their other near-term competitors are. And they've got this energy and their drive to do actually some cost cutting with regards to where Google is. Google's always been a cash flow monster, and most of the cash, and the only reason why they've even had like net negative operating cash flow, I mean operating margins on some of its earnings, is because they have a lot of side bets that Google's always been taking. But even that they're scaling back on a little bit to make sure that they're focusing on their core business. And I think that's going to be a key for them going forward. So right now I think Google is in a very good place. The other thing to consider also is, like, from a macro standpoint, like, I have been over the last month just trimming more speculative positions that I've ridden up on, and instead focusing on more things that I know that are going to be insulated from a recession. Now, what do I mean by that? Like, I'll give you an example. SoFi, like when SoFi hit like 1050, I was like, you know what? Even though I like this company and I think that it has the potential to get to, you know, a much higher valuation in the short term, it's written up significantly, and any sort of headwind in the economy can see this come down very quickly. So I said, you know what, the best thing to do, take some profit, pay the taxes on the profit, take the money, either sit in cash or find a home for it where it's going to be in a business that's a little bit like less impacted by the recession. And in my opinion, companies like Google, Microsoft, those are the ones that you want to be in, because even from like an investment standpoint, when the recession does come, people are going to be doing that, which is they're going to be high classing their portfolio, right? Where they're going to say, you know what, maybe I'm going to sell out of my speculative, but they'll be doing it as there's a recession. Me, I'm taking the prudent step of doing it before the recession comes. And I could be wrong on that, by the way. You know, there could not, the group think right now when it comes to recession is that there will be no recession. Everything is going to be fine. Me, on the other hand, I'm like, man, based on the research I'm seeing layoffs. I'm seeing people losing jobs. Like, tell me how this, like, I'm seeing an inverted yield curve that's like all time high. Tell me that there's no recession, you
Yeah.
know? So it's one of those
Well,
things that's just
my
hard
my
to,
question is though, are these
yeah.
like prudent layoffs, like you kind of said? Like I anticipated that the revenue and net income impacts for say Google, Amazon were going to be much more exacerbated than they really were. I thought that there were going to be, you know, huge sums of potential year over year sort of dips in terms of revenue, and maybe that's yet to come. But so I was anticipating that those layoffs were, you know, going to be more severe. You know, I know that I say that. I mean, there was tens of thousands of people laid off, and I feel bad for those people, and you know, understand. But do you think it's more of that getting to that point where we know efficiencies are needing to be made, and a lot of people were hiring like crazy over the past 2 years to kind of keep up with demand, and now it's an opportunity to kind of say, well, this is where we overhired, this is where we underhired, very similar to what Palantir did. Let's knock off these 5% of people in sales and focus on, you know, the software piece. So there's that. And then another piece that I was thinking about that I wanted to ask you is, in terms of SoFi's future competition, we don't have to make an entire discussion about it, but in terms of SoFi's competition, do you think that's extremely limiting for their upward mobility and potential?
You know, when it comes to SoFi, I think a lot of the bull thesis is on operational efficiencies that can be built into a sector that's in transformation mode, right? Where you don't need as many physical brick and mortar businesses. So a lot of banks have legacy costs that deal with that, where SoFi doesn't. And SoFi is catering to a brand new set of what is that thing called, of consumers that are looking for a 100% digital experience. And so I think that there's something something to be said about them being able to grab market share from the traditional banks, which are a lot more sclerotic in their way that they operate, where they have like so many like ways that they've done things. It's, you know how they say like, if it's not broken, don't like, we don't need to fix it. The problem is that kind of thinking is really bad, because that also means that like from an innovation standpoint, you're not really investing in the future for that. Whereas SoFi will be able to attract newer consumers that are a lot more savvy with um, with um, with the digital banking experience, and be able to grab market share. And it comes down to, even from an operating cost perspective, SoFi can offer better rates for consumers on their products, which the other banks can't, because it'll cut into their margins, which are already pretty razor thin. So
Yeah,
what are you
the
going to
brick and
do? So
mortars.
yeah, so that's one of those things that you have to understand the thesis behind it. And I think also there's a bull case to be made about leadership aligning themselves to that future growth, right? Where SoFi, you can see that Anthony Noto is probably one of the main drivers of this innovation that's happening, right? Where he's seeing far beyond what the normal bank CEO is seeing, and is able to communicate that with not just shareholders, but also with consumers, and make products that are attractive to consumers. Otherwise, you wouldn't have seen the growth that you saw in the number of new accounts, right? Tell me which bank right now in the country is opening that many new accounts, because I don't know any. I don't know any. Most of them are living off of their legacy accounts that they've opened for quite some time, and they're just literally like flat. The good thing about them is that most of them are trading way below their book value,
Yeah,
which makes them
exactly.
a good an attractive investment to make. But in terms of like growth potential, SoFi has better growth potential going forward. So I think that's the bull case on SoFi. You know.
Hmm. So, two final questions. The buybacks for Palantir, going back to Palantir, sorry. Do you think that that's prudent, or do you think that it's a little too early?
I think they authorize these buybacks. I don't think they are going to actually utilize them. I think this puts a floor under the stock price. I don't necessarily think that they should buy back. Dude, if you're buying back shares at 18, 19, $20, I seriously have to like question your CFO's judgment at that
Yeah.
point, because you're literally overpaying the shit out of those shares. On the other hand, if you authorize that buyback, save it, the economy sours and somehow the market sells off and your stock drops to $8 and you buy back a whole bunch of shares, I will clap for that person. So I think it's all going to depend on what the CFO does. This just gives them optionality, which is,
Mhm.
I think, more important than the other way. The other thing is also, from just a profit margin standpoint, you're getting more profit from your treasuries right now. Your treasuries are
Yeah.
yielding a great return, and just your interest income. So why would you want to go the other route and buy back shares when the net profit margin is less than 2%? You're better off with the treasuries and just
Yeah.
chilling on that. So,
My thought
yeah,
process is they might use the profit from that. So I don't think that they would go anywhere between a bit. Like, I don't think they're going to buy $1 billion worth of shares today, right, or
mhm,
tomorrow, or anything of the like. I think what it is it's more of a long term offset to share based compensation that I think that they hear retail investors complain about all the time, and so I think it's going to be to partly offset that, to realize some of that today. So I don't think that they'll go more than 20 or $25 million in a quarter in the next few
yeah.
quarters. And that gives them a long runway. So I don't think that they'll coming out, because you think about it, it's like they're making 100 to $200 billion in cash flow from operations every quarter. I don't think that they would go back and
I,
be like, okay, instead of adding to the balance sheet, like, let's buy back all these shares. I think it's going
yeah.
to be a part offset.
I think there's something to be said about also stabilizing the dilution, right? That's another thing that you have to keep in mind. You can use the cash flow as a substitute for slowing down the dilutive effects of the share count. That's the other problem that you're having also. So if you have an employee compensation plan based on a lot of dilutive shares, it's not good for shareholders, and most shareholders are complaining about that. So being opportunistic about issuing shares to employees is great, but also having the liquidity to buy back some of those shares very cheaply is great, because now you pretty much are paying the employees with monopoly money. You know what I mean? So imagine you get issued a RSU at $20 and you're able to buy back those shares at 10. You basically told the guy you're getting a $200,000 salary, but it's only costing me technically 100,000 because I bought back the shares at 100. So your RSU is it's mad, it's financial mumbo jumbo that you gotta play the game with, but that's just how the game is, man. So
Yeah.
right now, I think as shareholders, this was a good move to have a floor put in. So if anyone is expecting Palantir to get to $6, good luck, because at that point they're just going to deploy their cash and just buy back as much shares as they can, and kill you. You know. So right now their RSUs, the new hires, are probably based on a $20 valuation on their stock, and they're probably going to use the cash to buy it back at 10. So it'll be interesting.
I wouldn't be surprised, kind of getting back to that S&P 500 and trimming back on the OPEX. I wouldn't be surprised if Palantir, kind of like what Conley here is kind of suggesting, where they just ride the 1 cent of profit just so they can qualify. I wouldn't be surprised if they ride that for a few years and slowly start to, like, as they go to 5 cents a quarter or 10 cents a quarter, they slowly start to kick back to kind of what you were talking about, which is, okay, let's go expand a little bit faster, or try to get a little bit more money through the door. I wouldn't expect them. I kind of have a $1 EPS for year or for full fiscal year 2026 on like an adjusted basis. Kind of removing that stock-based compensation, because that is going to be $400 to $500 million that year alone, if not more. But my thought process is they're probably going to ride that for quite some time, where they slowly kick back to, as revenue grows, their net, adjusted gross operating, or sorry, their adjusted net margin continues to grow. It's 24% today, but it could grow to 30-40%. They'll continue to either adjust share-based compensation to get more employees, or they'll go expand a little bit more. The last question, I don't know if you can answer on that, but the last question I had was going back to Google. You did mention their chips and their TPUs that they were kind of building. Do you think that that is going to be the next growth engine for Google, or do you think that there's going to be something that comes out of some of their other bets that becomes the next growth engine? The reason being is, you and I discussed the other night about Ruth, the CFO, being put as now this head of, or the CEO of other, like, I forget what her official title is.
Other bets. She has CIO now.
Chief CIO of other bets. So do you think that those TPUs, I don't know how much monetization you could do outside of Google, or if that's just helping them internally? Or
no, it's helping them sell cloud services, essentially. What it is imagine right now being wholly dependent on NVIDIA for everything. So now you're setting yourself up as a bottleneck, right? So if someone comes to you and says, look, I want to set up an AI instance where I'm using AI tools with Google products. Number one, you're going to have to pay the toll bridge of NVIDIA. And Google still buys from NVIDIA, don't get me wrong, but having your own proprietary chips is something that everyone is moving towards. Not just them, but Microsoft, Meta, Amazon has their own proprietary chips that are specifically built for AI acceleration. So the thing is, you don't want to put yourself in a position where you're relying on NVIDIA's good graces in order to grow your business. That's the good thing about Google. Because they're TPUs, it gives them the optionality where if cloud grows really fast, they can just get more TPUs and more GPUs from NVIDIA and, set it up very quickly. And there's no bottleneck, whereas other companies are going to have to. And the thing is with semiconductors, there's a lead time that you have to do all this stuff with, right? Next generation of TPUs are actually very comparable to what the NVIDIA current generation of GPUs are, without having to pay. Bro, GPUs from NVIDIA right now, the H100s, they're fucking expensive, dude. Like, have you seen some of the prices for these things? There's like a black market for AI chips right now. You know? So I mean, they're
like the $40,000-$50,000 range, right? That's something absurd.
For one GPU chip. One, okay? They're worth more than gold right now. So,
Well, I do want to say there's 170 odd, I think, people watching right now. I think the most let's do to Palantir. So congrats to all the the continued success of Palantir, folks. I do want to give an opportunity for everyone to check out Chris and his Patreon. Look in the description below. He has his Twitter. The Patreon link is down there, and then also, at least I think I started putting the Patreon link down there, and his YouTube is there as well. So be sure you follow Hot Chris. Please also like the stream if you haven't already, and let me know, Chris, is there any other details that you wanted to highlight tonight? I think we covered a lot of different interesting thoughts, and it's good to hear your thoughts on Palantir not always being so bearish as you like to portray on Palantir Weekly.
You know what it is? Sometimes it's not just sometimes you got to play.
You have to be the voice of reason. No, you got to be the voice of reason. I always applaud you.
Sometimes it's fun to play the bad guy. You need, without you won't believe how many people tune in just to throw tomatoes at the bad guy. You remember like when you go to like the circus and there was this thing where you get to throw, you know, like a ball, and then like if you hit the target, it would dunk the guy in the water. You know, sometimes you gotta do that. Otherwise, I try to bring some reasoning behind my thesis, but I also won't but I also understand playing the entertainment side of the bad guy is actually kind of fun too. So, you know, maybe I need to downplay that a little bit. Otherwise, I don't want people to think that I'm not a serious investor, that I'm just like being you know, just being bearish to be bearish. But what it is if I'm already in the zone of, hey, I think the valuations are a little high, and I don't want to necessarily invest, you know, I want to be a little bit entertaining with it. Like today, I don't know if you saw my Twitter post with hold on, let me just show you real quick.
I haven't checked it yet. I haven't watched much Twitter because I was at the office pretty late.
Let me just show it. Are you sharing my screen real quick?
Yeah.
So you remember, like, this is like one of my favorite characters, Mugatu.
Yes, Mugatu.
so
it's so hot like, right now.
Yeah. So I'm like, I feel like I'm taking crazy pills. I invented the piano necktie. I did that. What did you do, Derek? You know?
Nothing. Sorry. Yeah, it's yeah, dude. Yep. Mugatu is a funny one, man. That's a great movie, underrated movie for sure.
Yeah.
And I saw there you're almost at 7K. So everybody that's on the stream, 155 of you. If you're not following Chris on Twitter, I will find you and hunt you down. We got to get Chris to 7K, hopefully the next few days or so. Yeah, but cool, man. Oh, I appreciate it.
Yeah, and it's funny because I think some of the community also comes at, man, y'all are vicious, by the way. The Palantir community, bro, you guys come hard, man. Sometimes I'm like, man, I don't want. Maybe I need. There have been a couple of times where I could have been on Palantir Weekly, and I'm like, maybe I need to figure out what I'm going to do today instead of being on the weekly, you know? So,
well, it's funny because sometimes, you know, I go, you know me, I've started to play that wishy-washy entertainment factor a little bit more, saying Palantir is going to zero. And I love it when people are like, what? You're effing crazy. And I always bring back like the, whatever that, the Willy Wonka guy that you must be new here sort of face. And you know, I love trolling on people to that extent because they're like, it's so serious.
You gotta have fun. You gotta have fun with it.
This guy must be a permabull if he thinks it's going to zero. I'm like, yeah. So it's pretty fun. And I saw a few of those and the FJ stream because you guys got up to over 800. So anyway, cool.
Yep. Always a pleasure, man. Have a good night.
Always a pleasure. Much appreciated. Talk to you guys soon. Cheers.
Later. Bye.